going on is that the market is going through a typical digestion phase after advancing more than 20% in the prior year. We've had 20 of those kind of years since World War II, and every one of them had a decline of 5% or more, with most of those declines taking place in the first quarter. This time around, the trigger is the nervousness over the Fed, over interest rates, over inflation, as well as the tensions in Ukraine. And so whatever the catalyst is, it causes investors to take profits from what they experienced last year and hopefully reset the dials so that we can end up with a positive full year. I think that the reason that the market did so well last year, yes, absolutely, was because of all of the liquidity that investors had, the lack of attractive alternatives. So investors were focused more on equities in general. And because it seemed as if the market was just not going down, they were much more willing to go further out on the risk curve by buying high beta tech stocks, consumer discretionary, Bitcoin, and so forth. And now they're paying for it by being too exposed to these high beta areas, especially when they are collapsing in price. I think investors look toward technical analysis to decide how far down the market is likely to go. Today, we did retrace almost 23% of the advance that we saw since the bear market low in 2020. That is a typical retracement level, bringing us down to about 4,200 on the S&P 500. I think that the Fed is probably what investors are going to look for is to hear whether the Fed is going to remain fairly hawkish in its tone, implying that it will raise rates 4 times or even more in the year ahead, that they will be accelerating the tapering and start to talk about whittling down their balance sheet. So if the Fed is speaking still very hawkish, then I think that's going to cause investors to become even more concerned. And the next level that technicians will be looking for is close to 3,800 on the S&P 500, which would throw us just barely into a bear market at about 20.5% decline. So really, it's going to depend on the tone of the statement by the FOMC, whether they do cut interest rates, which we don't think that they will do this time around, and the tone of Fed Chair Powell during his conference, his press conference afterwards. I think based on how rapidly the market has fallen, small cap stocks already in bear market territory, the NASDAQ in deep correction territory, and the S&P 500 in a deep pullback mode, I think the Fed has to realize that if it does not want to be the cause of the panic themselves, that they need to tone down their rhetoric. So I would not be surprised if we actually see the markets recover on Tuesday and Wednesday ahead of the Fed statement and initiate a relief rally. The first 5 days of January, which is an early warning signal for the entire month, was negative. If we end up with the negative first 5 days and the full month being down for the S&P 500, historically, that is not a good signal for the entire year. That on average, the market has fallen more than it's risen, and the average price change has been a decline of about 6%. So I think that investors are facing a pretty challenging 2022. It is also a midterm election year called the sophomore slump for the president. And historically, we find that the second and third quarters are also very volatile and are typically down.